Audit and assurance. In previous lecture, we have discussed about audit planning. Our ISA 300, an auditor must perform audit planning before starting the audit work. And there are two main activities of audit planning. Auditors should prepare audit strategy and audit plan. And we have differentiated between audit strategy and audit plan. Audit strategy means to highlight risky areas and direct the work of auditing, while audit plan is a detailed procedure plan about how to conduct the audit. How we can highlight risky areas? We can highlight risky areas through understanding the entity and its environment, through analytical is production oriented. So this we will should obtain control system. We should obtain investigations, obtain knowledge of objectives, strategies, and related business risk, and obtaining knowledge about management methods used to measure its performance. Examiner can ask these points in MCQ, so you should be aware of these 5 points. He can of these 5 points and can ask you to not include in understanding the anti environment. Can highlight risky areas through analytical procedure, mean comparing financial data with the financial, mean current year financial statements with the previous year financial statements, with the industry, in comparative financial statements with budgets, with the non-financial data, in comparing current year financial statements with the statistics. How we can highlight risky areas. How we use ratio analysis, we will cover some questions today. Assessment is the most important and technical area that we will cover today. Today's lecture, we will just cover one topic, that is risk assessment, mean audit risk. We can highlight risky areas of framework. And the risky areas we have highlighted through audit strategy, what we will do, we will define audit plan accordingly. What are the components of audit plan? Identification of critical areas. We will include the risk of critical, mean risky areas in audit plan for the audit team, so that they should be aware what are the high risky area, mean where misstatement chances are high. And those high risky area will be called critical, mean important areas from audit point of view, where we need to check things in more detail, where we have to spend more time during the audit. And we need to define preliminary materiality. How to define preliminary materiality, we will discuss today again. And we need to define nature, timing, and extent of audit procedure, mean response to risk. And all these things we will communicate to auditor team so that they should be aware what are the risky areas where they have to perform detailed work, mean perform substantive procedure. We will define some materiality level, mean below this amount, any misstatement will be considered immaterial, and above this amount, misstatement will be considered material. And we have defined against what account balance they have to perform, what kind of procedure, either test of control, substantive procedure, when they have to perform, after year end, before the year end, or extent, mean how much transaction they have to verify, mean what could be the sample size of your audit testing. And if audit team work as per these defined audit plan, audit will be completed on quality basis, within time and within cost. So we have discussed detail of understanding the anti environment. We have discussed detail about analytical procedures. three types, three levels where analytical procedures are used during the audit. And we started detail about materiality. Let's discuss few things more about materiality and then we will move towards audit risk. Materiality we defined. Who use the materiality? Auditor use the materiality concept when he need to decide whether I should give qualified opinion, mean against company, or unqualified opinion, mean in favor of company. Unqualified opinion mean financial statements give true and fair view. Qualified opinion mean financial statements do not give true and fair view. Qualified opinion mean against company. Financial statements do not give true and fair view. Unqualified mean in favor of company. What is in favor of company? Financial statements give true and fair view. Based on materiality. If the misstatements in financial statements are material, mean big, influencing decision of any user, this means financial statements are not true and fair. Financial statements do not give true and fair. But if the misstatements are immaterial, mean not big, not influencing any decision of user, those immaterial misstatements can be ignored easily because having no impact on the financial statements. So we'll say financial statements give true and fair. And materiality vary from user to user, from company to company. But if during audit we have found any misstatement, how we can judge whether it is material or immaterial? We can see misstatements either through quantitative materiality or qualitative materiality. Quantitative mean whether this amount, suppose during audit we have found 50,000 misstatement. So whether this 50,000 is material or not, the amount is material or not, we will see quantitatively. And in quantitatively, we will use some threshold. Mean we will use our rule of thumb. If that misstatement is a 5% or more of profit, we will be considered material. If it is less than 5% of profit, we will consider it immaterial. But we shouldn't compare with profit only. We should also compare with revenue sales figure as well. And for sales, threshold is 1% or more of sale will be considered material. Below this will be considered immaterial. There are some balance sheet items that are having no link with income statement. We cannot compare them with the profit or revenue. Like a receivable, having no link with profit or sales. Any goodwill, land and building, plant and machinery, having no link with sale or profit. So we will compare with the total asset figure. And while comparing with total assets, what's the threshold? 1% or more of total assets will be considered material. Below this, immaterial. Mean if any misstatement is not meeting materiality threshold with the profit, we will also compare with the revenue. If it is meeting threshold with the revenue, we will consider it material misstatement. We shouldn't only check a quantitative materiality, we should look for qualitative materiality as well. What is qualitative materiality? Nature of transaction. Like any non-compliance with law regulations or accounting standard will be considered material misstatement. Whether the amount is immaterial as compared to quantitative, qualitatively it will be considered material misstatement. Like IAS 1 says, director transactions should be disclosed in the financial statement. And if directors have performed any transaction with the company, there should be a disclosure in the financial statement. Whatever the amount is. Director has performed a $1,000 transaction with the company and they didn't disclose in the financial statements. It looked embarrassing, like just 1,000 transaction we are going to disclose in the financial statements. 1,000 is nothing. 1,000 quantitative point of view is nothing. But from qualitative point of view, it will be considered material misstatement as per standard director transactions should be disclosed. If they are not disclosing, we will consider it material misstatement, qualitative part. Or if there is any fraud happen in the company accountant made any fraud. If there is any fraud in the company, it should be corrected and disclosed in the financial statement, regardless of the amount. Because fraud is a wrongdoing. It's corruption. Whether the amount is $10 involved, fraud is wrong thing, corruption. It should be highlighted so that we can prevent these things in future. If we are not highlighting these things, we will not be preventing these things occurring again and again in future. So this means this fraud should be corrected in the financial statements and should be disclosed in the financial statements. If it is not corrected or not disclosed, this is material misstatement, not quantitative point of view. Qualitative point of view, nature of transaction is wrong. If a small amount convert profit into loss or vice versa. What does mean by vice versa? Loss into profit. Suppose current year company financial statements showing 10,000 profit. And during audit, we discovered company didn't record 15,000 expenses in the financial statement. How much is the expense? 15,000 they didn't record in the financial statement. 15,000 we compare materiality, it was quantitatively immaterial. As this 15,000 expense is not recorded, if it had been recorded, there was 5,000 loss for the current year rather than 10,000 profit. In changing the whole view of the profit and loss account. So 15,000 is a small amount. But if corrected, will convert profit into loss or loss into profit, we will consider it material misstatement, qualitative one. Because this profit 10,000 instead of 5,000 loss is affecting decision of the investors. Because if any investor see 5,000 loss for the company, they will not make investment in this company because this is already loss making. It's already sinking ship. We are going to lose our money in this company. But if company is showing profit, suppose little bit 10,000, okay, they will be sure company is having profit, they will improve in future, okay, make it. So this small amount influencing the decision of user. So quantitatively 15,000 is not material, but as it converting loss into profit, so we will consider it material misstatement, qualitative point of view. Can you understand this? Okay. What happens? We have defined the rule of thumb 5% or more of profit. Instead, standard has defined this threshold is a 5 to 10% or more of profit will be considered material. 0.5% to 1% or more of revenue will be considered material. 1% to 2% or more of total assets will be considered material. Mean standard on materiality, auditing standard on materiality has defined the threshold in bracket rather than single. But during exam, while attempting question, we will consider materiality based on these percentages, 5% or more of profit, 1% or more of revenue, 1% or more of total assets. Is it fine? What we do, how we define preliminary materiality levels. At start of audit, during planning stage, what auditor do? take the financial statement, see what is the profit figure. They compute 5% of profit and write down a figure that is materiality of profit. They check what is the revenue of the company. They calculate 1% of revenue and define this materiality for revenue. They check what are the total assets of the company, calculate 1% of total assets and define this as materiality. And we have already defined this materiality for the audit team. So that if during audit, they are finding any misstatement, they will compare with these amounts rather than calculating whether it is 1% of that or not, whether it is 5% of that or not. They will compare with these amounts. If the misstatement is below this, ignore. If it is going above this, we'll consider material. This is called preliminary materiality. Mean initial materiality levels that we have defined for the auditing against which we will measure materiality, or this will also called, you're having space here. Yes, this is also called materiality of a whole financial statement. This will be called preliminary materiality or materiality of whole financial statement that we have defined at the planning stage for the auditing. Is that fine? What happens? Suppose during audit team is finding so many small immaterial misstatement. Meanwhile, comparing with these figures, they are immaterial. They are finding so many. If you are finding so many small immaterial misstatement, what auditing standard says, you should not ignore that. What you need to do, you need to make a list of those small misstatements. And at the end of audit, you should make their total. And the total figure you should compare with this figure. If the total mean aggregate of small immaterial misstatement is material, we will consider it material misstatement. Because if there are 2, 3, we can ignore. But if there are so many small immaterial misstatement, we shouldn't ignore them. We should check their combined performance, whether they combined are becoming material, we will consider it material misstatement. This concept is called performance materiality. In checking materiality of small immaterial misstatement in aggregate. Checking materiality of small immaterial misstatement in aggregate, this concept is called performance material. Or what other concept of performance materiality? Performance materiality concept says, if you are finding so many small immaterial misstatement during the audit, what you need to do, you need to revise your materiality level, mean reduce your materiality level. If suppose initially we calculated materiality based on a 10% of profit. Now we should define materiality level, preliminary materiality on 5% of profit. If initially we calculated materiality on 1% of revenue, what is the below percentage? 0.5%. Now we should reduce the materiality preliminary to 0.5% of revenue. Because we are finding so many immaterial misstatement. This means there are issues. So we should consider the material by reducing our preliminary materiality. This is also called performance materiality. Here's a definition of performance materiality. Setting materiality levels below. Setting materiality levels below materiality of a whole financial statement. What was the materiality of whole financial statements? This preliminary materiality that was calculated on 10% of profit, 1% of revenue. Now we are reducing them to 5% of profit, 0.5% of revenue. So this is called performance materiality, means setting materiality levels below materiality of a whole financial statements. And when we can do that, when we are finding so many immaterial misstatements during the audit that are not becoming material as per our preliminary materiality level. So this means standard allow us during audit, if we are finding so many immaterial, we can reduce our materiality levels because there are issues. So in case of issues, there are problems. In case of problems, we can reduce our materiality level to performance materiality.
What if they're immaterial with the initial threshold? Then why are you trying to make them material?
Because there are so many. If there are two, three, we can ignore. We don't need to move towards performance materiality. If there are so many material, then we should move towards performance materiality. Otherwise, might be those are so many will create combined material effect at the end of audit. So there are two concepts of performance materiality. Either make a list of immaterial at the end of audit, check their total. If material, consider it material, or reduce materiality level to performance materiality. What's the better approach? Reduce materiality to performance materiality. Mean at start of audit, we have defined preliminary materiality levels against which audit team need to compare misstatement. If below this, immaterial, ignore. If above this, material. But if audit team finding so many immaterial misstatement during the audit, this means there are some problems, there are some issues. Might be management knew about our materiality levels. That's why they have created misstatements below that amount because auditor will ignore. In that case, we should not ignore those immaterial mistakes. If there are so many. What we need to do, we need to make a list of those immaterial misstatements. And at the end of audit, we should check their combined performance, mean total. We need to consider if it's material, we will say there is material misstatement, not individually, in aggregate, mean in combined. What is the other concept of performance materiality? Instead of making a list of those immaterial, what you need to do, you need to reduce your materiality level. In initially, you have calculated revenue materiality on 1%. What is the threshold? 0.5% to 1%. So now you should change this preliminary materiality level to 0.5%. It might be based on 1%. This figure is 100,000, but based on 0.5%, it will become 50,000. Now checking materiality because now we have reduced. This is called performance materiality, means setting materiality level below materiality of whole financial statements. What was materiality of whole financial statements? These preliminary materiality. Now, if we are changing them, reducing them, means setting materiality below then preliminary, this is called performance material. Is that fine? Okay. So let's move towards the most technical and most important topic in any of the audit paper. There are two technical topics in audit. One is audit report that we will discuss end of our syllabus. The second most technical topic is audit risk. In at planning stage, we have to highlight risky areas through risk assessment. Risk assessment means assessing audit risk and its components. Assessing audit risk and its components. So let's discuss what is audit risk and what are its components. Audit risk. Audit risk means a risk of giving inappropriate opinion due to undetected mistakes. due to undetected misstatements. What auditor do? Auditor need to detect misstatements in the financial statement. If he is unable to detect misstatement, but he will say financial statements give true and fair. While in fact, financial statements was not true and fair. This means our opinion could go wrong. Mean the chance of giving a wrong opinion, inappropriate opinion is called audit risk. The chance of giving inappropriate, mean wrong opinion is called audit risk. And we have to assess this risk at the planning stage. Like if company management integrity is doubtful, there are high chances of audit risk. Because if management integrity is doubtful, mean they are like corrupt people, there could be chances of misstatement in the financial statements. That if we unable to identify, we will be moving towards inappropriate opinion. So how we can reduce this audit risk? By appointing more experienced staff to audit of this client. If there is low audit risk, we can go with any of the experience of audit staff, that's fine. But if audit risk is a high, this means we need to move towards more experienced staff, and we should adopt our audit approach as substantive approach. In very first lecture, we have discussed there are two approaches of audit. System-based approach means tax step control with reduced substantive. Mean only main account balance, large account balance we need to check in detail. But a substantive approach, every account balance, whether it is large or small, we need to check them in detail. If audit risk is high, we should move towards substantive approach. We should go with more experienced audit team. If audit risk is low, we can adopt system-based approach and we can go even with less experienced audit team. What is audit risk? A risk of giving wrong opinion due to undetected mistakes. We should identify and assess audit risk at planning stage. There are three components of audit risk through which we can identify, assess whether audit risk is high or low. What are its components? Inherent risk, control risk, and detection risk. Inherent risk, control risk, and detection risk. In audit risk, AR is a model of inherent risk into control risk into detection risk. This equation is called audit risk model. In audit risk is equal to inherent risk into control risk into detection risk. What is inherent risk? A risk due to nature of company. Company means client company to whom we are going to audit. Or we can say inherent risk, a risk that misstatement may occur. Inherent risk, a risk due to nature of a company or a risk that misstatement may occur. Meanwhile, obtaining information of client company, if we are aware there is a chance of misstatement, so that will be called inherent risk. It could be due to nature of company. It could be due to some other information. Like we are going to conduct a company who is selling high fashion products. If products are high fashion, due to nature of company, there is a high risk of misstatement in inventory. Because high fashion inventory could become obsolete quickly. IAS2, you have learned in financial accounting. IAS 2 says inventory should be recorded lower of cost and NRV. What is NRV? Selling price less cost to sell mean their value that can be realized from the market. And for obsolete inventory, always their NRV is lower than cost. Normally, company record their inventory on cost because cost is higher, NRV cost is lower. NRV is higher for normal inventory because NRV is a selling price. Selling price means cost adding profit. But if for obsolete inventory, company also recording them on cost rather than on NRV, chances that inventory could be overstated. So this is called inheritance. If company is running any fashionable products, operating in fashionable products, or companies operating in technological products, even technological products become obsolete quickly. So there is always chance of overstatement of inventory if company not recording inventory lower of cost and NR. Makes sense. Due to nature of company. What is nature of company? Company is operating in technological products. Company is operating in high fashion products. So let's write down examples as well. Technological products or high fashion products. Because these example will help us while attempting question. So in that case, what is the issue? Overvaluation of inventory. If not recorded, lower of cost and NR. Is that fine? If company selling books, DVDs, again, there is an issue of overstatement of inventory because the book is out of trend now. DVDs out of trend now. So there are chances inventory could be overvalued if company not recording inventory lower of cost and NR. One example. If while obtaining information of the company, we are aware that the company is going to obtain bank loan. Company need bank loan for survival. This means company financial are not good. That's why company going for bank loan. How bank will approve the loan? Bank normally approve loan based on certain conditions. If your profit will be this percent of revenue, who will give you loan? If your total assets will be that much of your liability, mean above your liability, loan will be approved. And suppose companies are going for loan and not meeting condition of the bank, there are chances of manipulation in the financial results. This will be called inherent risk. Mean company is going for obtaining bank loan. So if bank loan conditions are not fulfilled by the company, there are chances of manipulation in financial statements. Manipulation means company can either overstate or understate some of the account balances as per the bank required. You have learned interest cover ratio in financial accounting. How to calculate interest cover? Profit before interest and tax divided by interest expense. What this interest cover ratio tells about? How many times company can pay interest from given profit? Mean how many interest installment company can pay from its profit? If interest cover answer is a 5, this means company can pay 5 interest payments from its profit. If company interest cover is 8, 8 interest payment company can make in from the profit. This is much better. If interest cover is a 2.5, so bank impose these kind of restriction over the company, like your interest cover should be above a 5. Then we will approve the loan. And if suppose company interest cover is not above 5, what company will do? They will highlight the profit. So that interest cover should be according to the bank. So this is called manipulation in financial statement. Is it fine? While obtaining information of the company, if we are aware company is going towards the stock exchange listing, mean company is going towards listed on the stock exchange, so that company can issue shares in the public and generate money through share capital. To be listing on the stock exchange, there are some threshold that you need to meet. There are some condition of the stock exchange that you have to meet, and if company is not meeting condition of listing, what company will do? There are chances of manipulation in the reserves. So company is going for stock exchange listing. There are chances of manipulation in financial statement. While obtaining information of the company, we are aware that a director receiving a bonus on meeting profit targets of the company. Mean they will receive bonus if company is meeting certain profit target. If company is not meeting the certain profit target, they will be having no bonus. If they are not meeting that target, they need bonus. How they can get bonus? Through manipulation in the financial statements. If they omit some of the expenses or record incomes as overstated, double next year income recording in current year expenses in a next year, they can show the target profit and get a bonus. So there are chances of manipulation. So we can say if a director's remuneration is based on bonus, so again, there are chances of manipulation in financial statement. While conducting audit of the company, we are aware that the company has made any investment in property. There is slump in the property market nowadays. Company has made some investment in the property and property market is in declining, is in slump. And if market is declining, this means your asset worth is not the same as you have written in your financial statement. Their worth is lower than carrying value. Carrying value means written in financial statements. This means if there is a slump, if there are chances your asset value is down, you need to impair your asset. And if company is not recording impairment loss, what is the accounting entry of impairment? Impairment expense debit, asset credit. Mean company haven't recorded this accounting entry. This means chances that expenses could be understated, profit overstated, as well as asset overstated. This will be called inherent risk. If there is any no impairment. So asset, profit could be overstated while expenses understated. This will be called inherent risk. Meanwhile, taking knowledge of the company, if we are aware there are any chance of misstatement, we will call it inherent risk. What else? What else? Have you learned IAS 37 in your life? Let's discuss IAS 37. Because in most of the audit risk question, examiner is having one example of IAS 37 audit risk as well. IAS 37 name is provision, contingent liability, and contingent assets. Provision, contingent liability, and contingent asset. When company need to record a provision by meeting three conditions. If any of the event fulfilling these three conditions, there should be provision in the financial statements. What are the conditions? Present, legal, or constructive. Present, legal, or constructive obligation from past event, probability of future economic outflow, cost can be measured reliably. When any of the event meeting these three conditions, there should be provision in the financial statements. Mean there should be recorded provision in the financial statements. What is the accounting entry of provision? Debit, expense, credit, provision, liability. What does that mean? Present, legal, constructive obligation from past event, probability of future economic outflow, cost can be measured liability. So in past, mean during the year, company has made any environmental pollution. And there was a law, company has breached that law relating to environmental pollution. This means there are chances body will impose, court will impose any fines, penalties upon the company. This means there is present legal obligation. There is present legal obligation. Mean you have breached the law, environmental law, or any of the law that happened due to past event, mean due to pollution that was event. So present legal obligation because you have breached the law. If you have breached the law, there are chances you will be facing fines, penalties. So there is present legal obligation from past event. I'm not discussing about constructive now. There is present legal obligation from past event. And if the chances of payment against fines, penalties are probable mean above 50% mean greater than 50%. Mean if that body have send you a notice, court has send you a notice, you have to make payment against this. This means there are chances above 50%. And cost can be measured liably, mean the amount is stated how much amount you have to pay as a fine or penalty. If all these three conditions have been fulfilled, you need to create provision in the financial statement. Though the payments will be made in future. If any payments relating to future, what you need to do, you need to record as liability, expense, as well as liability. So what could be the accounting entry? Debit, expense, credit, provision, liability. Is that fine? Company has breached any of the legal provision, mean company have done something against the law and there are chances of fines, penalties imposed on the company. There should be provision. Is that fine? If company has done something wrong that was not against the law, but somebody is taking action against the company is also defending the case. Company is also defending the case. Whether company have to pay the fine penalties or not, it will depends upon the case. Because if company won the case, there will be no fine penalties. If company lose the case, there will be penalties. This means there is no probability, there is a possibility. If there is possibility rather than probability, possibility mean chances are below 50%. Possibility mean below 50%. In that case, you have to disclose contingent liability in the financial statement. There is no accounting entry, but you have to disclose contingent liability disclosure where in notes to the accounts of financial statement. If there is a probability, there should be provision, accounting entry. If there is a possibility, mean the outcome of amount will based on future court decision. Amount is not measured reliably now. In that case, you have to disclose as contingent liability. Is that fine? What is contingent asset? If there is any chance of future inflow, if there is any chance of future inflow, you have filed a case against any other party to recover any damages. There are chances you might win the case. If you win the case, you will receive some money as damages. And there are probability of inflow. Probability of inflow. You should disclose contingent asset. There is no accounting entry. You should disclose where notes to the accounts. Contingent asset, contingent liability are not counted for. I mean, there is no accounting entry for these. Only disclosure is required. While for provision, there should be accounting entry, expense to provision. If provision is not recorded, expenses, liabilities could be understated, and if expenses understated, profit could be overstated. So what is present legal obligation? You have done something against the law. What is constructive obligation? Company has done something against which there might be chances of payment. That is not against law. Like company has provided warranty to the customer. If you are providing warranty against your product, there are chances you will face some of the warranty claim. And if you are facing warranty claim, you have to make payment against those warranty claims. And there are chances of future payments. In that case, you have to create warranty provision in the financial statement. This is constructive obligation. This is not imposed. This is based on your action. You have created this warranty. There should be provision. Company is going to redundancy. What is redundancy? Dismissal of staff or business survival. Dismissal of staff for business survival. Like you are not managing your financial properly due to having so many staff cost. So you have decided I should redundant mean dismiss 10 people from the job so that I can manage labor cost and business profit. If you are dismissing some staff for business survival, that will be called redundancy, and that is a fair dismissal. But while making redundancy, you have to give a notice period to the staff. Or suppose you have appointed staff on 3-year contract basis. If you are going to remove them before contract, this means you have to pay them for the complete contract. Then you can make it redundant. So if you have decided to redundant the staff, this means there will be some redundancy payment in the future. If there are chances of future payments, there should be liability. This will be called provision in the financial statement. Warranty, redundancy, non-compliance with law regulation. There should be what? Provision in the financial statements per IAS 37. And if company is not recording provision, chances that expenses, liabilities could be understated and profit overstated. So this is another example. provision. In case of no provision, expenses, liabilities would be understated and profit overstated. Is a fine. We are discussing about examples of inherent risk. Due to nature of company, chances that inventory could be overstated if not recorded lower of cost and RB. Or by obtaining information of the company, we are aware about any chance of misstatement, like company is going to obtain bank loan. So if not meeting condition of the bank loan approval, there are chances of manipulation in financial statement. Company is going towards the stock exchange listing. If not meeting condition of the stock exchange, chances of manipulation in financial statement. Directors are receiving a bonus based on financial results. If not meeting required financial targets, chances of manipulation in financial statement. Our company has breached some of the law regulation. There are chances of provision per IAS 37. If not recorded, chances that expenses, liabilities could be understated, profit overstated. There are chances company asset value could be down as compared to carrying value. If company not impairing their assets, chances that asset profit could be overstated, expenses understated. Meanwhile, writing inherent risk, we have to show what are the chances of a misstatement in the financial statement. What is meant by misstatement? If there are any chances of errors in financial statements, we will call it misstatement. Instead of word misstatement, we can use there are chances of errors in financial statement. If there are any chances of misclassification, if there are chances of overstatement, in overvaluation, like inventory could be overvalued. Chances of understatement or undervaluation, like in case of liabilities, expenses, liabilities could be in case of provision, no provision, expenses, liabilities could be undervalued. Any chances of manipulation, if there are so many over understatement, we will call it manipulation. Or if there is chances of any non-disclosure. If company has changed its accounting policy during the year, that change in policy should be disclosed in the financial statements. There is accounting standard IAS 8. It's in financial accounting. If company is changing its accounting policies during the year, as per standard, there should be disclosure in the financial statement. If company is not providing detailed disclosure in the financial statement could be misstated. So change in policy, another example. So non-disclosure in financial statement. During audit, we are aware that company is incurring losses from so many years. And to survive, company needs some finance. Company is incurring losses. To survive, company needs some finance. And if company is unable to get enough finance, there are chances of a going concern will be affected. What is going concern? Company will not continue in next 12 months. There's accounting standard IAS 1 says if company is having a going concern issue, there should be disclosure in the financial statement. If companies are not disclosing going concern issue in the financial statements per accounting standard, chance of misstatement in the financial statement. So in case of any going concern issue, so non-disclosure chances that company may not disclose in the financial statement, this will also be called inherent risk. What if your examiner says, while writing inherent risk, students are explaining the issue. Company is operating in a fashionable products. So inventory could become obsolete. This is inherent risk. No, this is incomplete. Company is operating in fashionable products, inventory could become obsolete. So there are chances of overvaluation of inventory if company do not record as per accounting standard lower of cost and RV mean overvaluation. This word you should must write while writing inherent risk. I mean, what is the chance of misstatement in financial statement? You should have mentioned this. I mean, you should have used one of the word from this. Company is incurring losses. So there are chances of going concern issue. Is that inherent risk? No. There are chances of going concern issue which may not be disclosed properly in the financial statement. Now it becoming inherent risk. Company is going to obtain bank loan. This is inherent risk. No. Company is going to obtain bank loan. So there are chances of manipulation in financial statements if company not meeting condition of the approval of bank. And while writing inherent risk, you have to mention what misstatement chances are there in the financial statements. Another example, company accountant is unqualified. Company accountant is unqualified due to lack of accounting standard and knowledge. There are chances of errors in financial statement. This will become inherent risk. Accountant is unqualified. So due to lack of knowledge of accounting standard, there are chances of errors in financial statements. This word error is stating what? Misstatement. Is that fine? So what is inherent risk? A risk due to nature of company. Because some companies by nature of business operations creating misstatement in the financial statement. So that will come under inherent risk. Or by obtaining information about the company, if we are aware that due to this issue, there could be misstatement in the financial statement. So we will write under inherent risk. Company going for bank loan, company going for listing, management remuneration is based on bonus. Company have invested in property, property is in slum. So due to this, what kind of misstatement can happen in the financial statements? We will write under inherent risk. And this is the most technical area. How to write down this inherent risk. There's one term called business risk. With business risk, a risk that business may not achieve its objective. A risk that business may not achieve its objective. Main problems of the business are called business risk. Company is operating in fashionable products. So inventory could become obsolete and business have to bear obsolete inventory losses. This is business risk, not inherent risk. But due to this problem, there are chances of misstatement in financial statements. Mean inventory could be overvalued if obsolete inventory is not recorded on lower of cost and NR. Company is incurring losses, so company might face going concern issue. This is business risk. But if going concern issue is not disclosed properly in the financial statement could be manipulated. This will be called inherent risk. Company has invested in property and property market in slump and company have to bear some losses on property. This is business risk. But if due to slump in market, companies not impairing their property assets, chances that asset profit could be overstated and expenses understated. This will be called inherent risk. Company has made some environmental pollution in the past. There are chances company will have to face fine penalties in the future. What is this? Business risk. If against those fine penalties per IAS 37 company not recording provision, expenses, liabilities could be understated and profit overstated. This will be called inherent risk. What examiner is saying student are stating business risk instead of inherent risk. I mean, they are explaining the problem, they are identifying the issue, but explaining business risk. They are not linking that issue with the misstatement. I mean, what kind of misstatement could happen in the financial statement? Which thing can be understated, overstated, or non-disclosure, or error, or manipulation? They are not explaining this, and they are losing marks. I mean, we should not highlight only the issue. Issue is a business risk. Due to that issue, what could be the misstatement in the financial statement? We have to link with that. That's why this is a technical topic. Means students are not linking with the misstatements. We will practice so many questions so that we can get good marks in this question. This is the main reason of a failure, especially in this paper. Because from this topic, student have to write the answer. There will be no MCQs. You have to identify 8 to 10 audit risks from the scenario. How we practice? Good practice. So what is audit risk? A risk of giving inappropriate opinion due to undetected misstatements. And there are 3 types of audit risk. Inherent risk, a risk due to nature of company, or a risk that misstatement may occur. What is control risk? A risk that control system of client company may not prevent, detect, or correct misstatements. Misstatements mean fraud and errors. I mean, this risk is relating to control issues of client company, mean client company internal control system is not able to prevent, detect, or correct mistakes. Company is having no internal audit department. If company is not having internal audit departments, so due to lack of monitoring of control system, misstatements may not be prevented, detected, and corrected by the system. We will call it control risk. We know internal audit department. No, different. So if there is no internal audit department, we don't need to link control risk with misstatement. These are the issues relating to internal control system of the company. We will discuss under control risk. If company is having no internal audit department, what we will say? Due to lack of internal audit department, there are chances control system will not be monitoring and misstatements may not be prevented, detected, corrected by the system. That's it. Company management attitude regarding policies is poor. And the management attitude regarding policy, there is a term called control environment. Poor control environment mean attitude of management regarding rules, policy is poor, mean they themselves are not following the policies. If they are not following the policies, other people working below them will also not follow the policy because they are considering them as role model. And if your role model is doing something wrong, definitely you will follow them. So due to this, misstatements may not be prevented, detected, corrected by the system control risk. What else? Company has introduced new IT system in the company. And whenever you install a new system, there are problems in early stage due to some bugs in the system that will be highlighted after 6 months and then will be corrected. Our employees are not properly trained about the system, how to run this system. There could be chances of errors. So if company has introduced a new IT system during the year, so due to early stage control weaknesses, misstatements may not be prevented, detected, corrected by the system. We will write under control risk. Or we can also write if accountant is unqualified. We can also write here as well, unqualified staff. So due to unqualified staff, means statements may not be prevented, detected, corrected by the system control risk. We can write it as inherent risk, but inherent risk we have to link with the misstatement, chances of error in financial statement. We can also write as control risk, mean due to unqualified staff, misstatements may not be prevented, detected, corrected by the system. This will be called control risk. Is that fine? So what are the control risks? A risk that misstatement may not prevented, detected, corrected by the system. What are the examples? No internal audit department. So due to lack of monitoring of the control, misstatements may not be prevented, detected, corrected by the system. Poor control environment. So staff will not follow the policies. So misstatements may not be prevented, detected, corrected by the system. Misstatement mean fraud errors. New IT system. So due to early stage control weaknesses, misstatement may not be prevented, detected, corrected by the system. New IT system we can also link with inherent risk. Due to early stage control weaknesses, chances of errors in the financial statement if accounting system is newly installed. And if staff is unqualified, so due to lack of knowledge, misstatements may not be prevented, detected, corrected by the system will be called control risk. And in audit risk question, there will be either one or maximum two control risk. There will be more inherent risk. What is detection risk? A risk that auditor may not detect misstatements. A risk that auditor may not detect misstatements. Why? Auditor is new. In auditor is going to perform audit of this client first time. So due to lack of detailed knowledge about client business, he may not be able to detect a misstatement. This will be called detection risk. I mean, due to the auditor. Auditor is new, mean going to conduct audit of this type of company for the first time. So due to lack of detailed knowledge about client business, because to detect misstatement, you should have knowledge about client business. If you are not having detailed knowledge, you will not be able to find where misstatements could happen. So due to lack of detailed knowledge about client business, auditor may not detect misstatements. There is any limitation imposed on the auditor, like a time limitation. Like management has said, client management has said to the auditor, you have to complete audit within 2 months. Within 2 months, might be he will not be able to perform detailed procedure on every account balance. Yeah. So due to this time limitation, he may not be able to detect a misstatement. This will be called detection risk. Any limitation imposed by the client management, like time limitation. Detection risk. It's due to auditor. And out of inherent control, detection risk, what risk is in control of the auditor? Detection risk. The other risks are not in control of the auditor. They are due to company system are due to company nature. Auditor is new. Auditor is unqualified. Auditor unqualified. Mean inexperienced. Unqualified are inexperienced. If auditor is unqualified or inexperienced, so he may not apply detailed knowledge of auditor. Due to this, he may not detect misstatements. This will be called detection risk. We can discuss in that. Or there is some problem relating to previous auditor. Previous auditor resigned due to some issue with the management. Might be management not allowing him access to the records. Might be management not providing him all the information relating to audit. So those issues could happen with us in the future. And due to that, we will not be able to detect the misstatement. This will also be called detection risk. Mean, according to his professional clearance, he was having some clashes with the management. And if those clashes arises with us, so we will not be able to detect misstatement. This will be called detection risk. So what is audit risk? Sometimes examiners say define audit risk and its components for 4 marks. What is audit risk? A risk of giving inappropriate opinion due to undetected misstatements. And audit risk comprise 3 components of audit risk: inherent risk, control risk, detection risk. What is inherent risk? A risk due to nature of the company, or a risk that misstatement may occur in the financial statement. What is control risk? A risk that control system may not prevent, detect, correct misstatements. What is detection risk? A risk that auditor may not detect misstatements. Either he is new, either there is any time limitation, either he is not having experience, or previous auditor resigned due to some issues with the management. So those issues could also affect us, and we may not be able to detect misstatements. Detection risk, a risk that auditor may not detect misstatements due to sampling risk and a non-sampling risk. Due to sampling risk and non-sampling risk. What is sampling risk? We, being auditor, perform audit procedure based on a sample rather than 100% testing. Sample. Mean if companies are having 100,000 invoices, we cannot verify 100,000 invoices. We will take a sample like 1,000 invoices. We will perform procedure on 1,000 invoices, and the results of 1,000 invoices we will apply on 100,000. This is auditor work is based on sample. Suppose in our class there are 100 students. Suppose we want to know how many students are having the blood group, say, B negative. How we can conclude this? One way is to test all the 100 students blood groups. Then we can find how many out of 100 are having blood group B negative. Or other way, we can take a sample of some students, test their blood group, and based on the sample results, we can apply on the whole class, mean 100 students. This 100 student is called population, and the sample mean part of population will be called sample. Suppose we have tested blood of 20 students. Out of 20, we found 2 students is having blood group of B negative. 2 out of 20, 10% students are having blood group of B negative. Or say we have obtained sample of 20 and out of 24 students got blood group of B negative. So 5% is the result. 5% or 4%? 4 out of 20, 20%. 4 out of 20, 2 out of 20, 10%, 4 out of 20, 20%. Who will apply this on 100 students? Like in our class, 20% students are having blood group of B negative. After some time, we took a sample of 30 students. Out of 30 students, when we tested, we concluded that there are 8 students who are having blood group of B negative. What is 8 out of 30? How much percentage? 26.26%. Based on sample of 20 students, we got the result 20%. Based on sample of 30 students, we got the result of 26%. Which one is correct? We are confused. We tested blood group of all 100 students. And the result we obtained was 26%. This means the result of this 30 student sample was accurate. This 20 student sample was inaccurate. Why? This 20 student sample was small. And due to small sample, it doesn't have all the characteristics of a complete population. In large sample, it possesses all the characteristics of a population. That's why result is more accurate. Mean this sample that we chosen from the population was not representative of the population. Representative of the population mean all the characteristics have it. This was representative, mean having all the characteristics. That's why its result was accurate. This is called sampling risk. If the sample chosen from the population is not representative of the population, and due to this, if we were unable to detect misstatements, this will be called sampling risk. How we can reduce sampling risk? By increasing sample size. By increasing sample size. Because if the sample size will be smaller, it will not be representative. And due to that, auditor may not detect a mistake. What is the non-sampling risk? If auditor suppose testing 100% transaction, he is unable to detect misstatement due to wrong procedures or wrong conclusions. Mean he is not performing correct procedure to test any account balance. Why? He is inexperienced, he is lacking knowledge. He is not qualified. Or he is performing procedure accurate, but making wrong conclusion. Mean instead of 1% of revenue, he is checking materiality of revenue on 10%. Instead of 1% of total asset, he is checking 10% of total asset. Or 5% of total asset. Because he misclude the threshold. He's applying profit threshold on revenue or revenue threshold on profit. This is wrong conclusion. So we can reduce non-sampling risk how? By giving training to the auditor or recruiting more skilled auditor to the audit. So detection risk could arise due to sampling risk. So we can reduce this by increasing sample size, or non-sampling risk mean due to wrong procedure application or wrong conclusion, and this can be reduced through training of the auditor or recruiting more experienced or qualified auditor to the audit team.
So, the auditor risk of detection.
Error by the auditor is detection risk. Error by company management, company staff, that will be inherent risk. Misstatement. Auditor is not making misstatement, auditor is detecting misstatement in the financial statement. So, what is audit risk? What is inherent risk? What is control? What is detection? We have discussed. Let's move towards a question. Small basic question. Yes. From this question, you have to identify audit risk. Can you identify by yourself? There are 10 audit risk in this question. 6, 7 inherent risk, 1 to control risk, 1 or maximum 2 detection risk. Check how many you can find. There are 10 risks. If not identified, try it again. You need to complete 10 risks. Okay, let's discuss. You have recently been appointed as auditor. You have recently been appointed. Auditor is a new. Yeah. Going to conduct audit for the first time. So due to lack of detailed knowledge about client business, he may not detect a misstatement. Auditor search and selection of a financial requirement and a human resource consultancy. The company is wholly owned by its two directors. Wholly owned by its two directors. Mean company is owner managed. If owners are managing the company, they normally don't follow the rules themselves. We are the owners. Why we should follow the policy rules? Why we should come on time? Why we should leave on time? Why we should sit till evening? Mhm. So there are chances of poor control environment because companies owner managed. So due to this, misstatements may not be prevented, detected, corrected by the system. We will write it control risk. We are learning. We are learning. Okay. Oh, sure. Learning. Who formed the company 2 years ago? There is another issue. Newly formed companies. There is a history about newly formed startups, businesses. More than 70% startup business failed in their initial 2 to 3 years. This is the research regarding startups, mean newly formed company. More than 70% business fail in their first 2 to 3 years. Why? Because at start they are having some money. If their operations, their product not becoming successful, they will be facing serious cash flow going certain issues. So as company is newly formed, so it might be facing cash flow going certain issues which may not be disclosed properly in the financial statement. Inheritance. How we will write it? Company is newly formed. Company is newly formed. So there are chances of cash flow going certain issues which may not be disclosed properly in the financial statements. Per IAS 1, if you are mentioning standard number, might be examiner will give you a distinction. So how many we have found? One detection risk, one control risk, and one inherent risk. We are learning. The company has expanded rapidly. Oh, company has expanded rapidly. What does that mean? If company is expanding its operation rapidly, this means company is over trading. And if any customer don't want to buy your product, okay, take it, pay in future. Doesn't matter. You can pay in future, take it on credit basis. So company has expanded rapidly. So there are chances of over trading. And due to this, company may not be able to recover amounts from the debtors. If over trading will result into bad debts. Yes. And there will be chances of bad debts. And if company not recording provision for doubtful debts, chances that debtor mean asset, profit could be overstated and expenses understated. So in the examples, write down two more examples, one relating to debtors. If company debtors have increased, there are chances of bad debts. And if company not recording provision for doubtful debts, chances that debtor asset profit could be overstated and expenses understated. Other example, new company, newly formed company, not new client, newly formed company in early stage having a cash flow going some issues which may not be disclosed properly in the financial statement.
So when you say expands rapidly, we have to assume those.
We have to assume company have done over trading. That will result into bad debts. That is business risk. Bad debts is business risk. Against bad debts, if provision for doubtful debts is not properly created. What is the provision for doubtful debts? Expense debit, debtors credit. The chances that asset profit could be overstated and expenses provision for doubtful debts is not recorded as expense understated. Make sense?
Yes. Is it an error or?
It's due to information chance or misstatement. Because if there are chances of bad debts, what you need to do, you need to create provision for doubtful debts. How? Irrecoverable debt, expense debit, receivable credit. And if company is not recording this,
How should we write it in the Excel?
so company is rapidly expanded. This means this is an indication of overtrading. Okay. Will result into bad debts. This is business if we have explained what's the issue. So if company has not recorded provision for doubtful debts, chances that asset profit could be overstated and expenses understated. Is that fine? Yes. This is another common example of inherent risk that examiner include in the question. Okay, we have find how much 1, 2, 3, 4. In the past 12 months, an additional 10 branches have been acquired throughout the country, bringing the total number to 15. Now companies are having 15 branches. And if company is expanding its operations, there are chances control system is not properly implemented on the new branches, newly branches. So due to early stage weaknesses, misstatements may not be prevented, detected, corrected by the system. We will call it control risk. So from the first paragraph, we have found 2 control risks, 2 inherent risk, and 1 detection risk. How many you have found? Some 1, some nothing. Let's see. Funding of operation is by short and medium term lease finance. Mean company is funding its operation through short and medium term lease finance, and lease says company should properly classify short term lease under current liabilities and long term lease under non-current liabilities. And if company is not properly classifying short term lease under current, long term lease under non-current, there could be manipulation or misstatement in the financial statement.
Can you also say going concern? Can you also say going concern risk? The financing with loan.
You can link, but mainly there is a chances of misclassification of short-term and long-term leases under current liabilities and non-current liabilities. Misclassification. Is that fine? If it is director's intention to take the company to stock exchange within 3 years, company is going towards stock exchange listing. If not meeting the listing requirement, chances of manipulation in financial statement. And to write these risks, you should have command how to write English properly, how to make sentence, how to link the issue with misstatements. And for this, we need to practice, practice, practice. Makes man, not only man, women perfect as well. So key to pass this paper, practice, 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 and practice. Staff are paid 100% by commission, which can total. This is total. Up to 75% of company commission take. In staff, remuneration is based on commission. Commission is based on some targets. Yeah. And if company is not meeting required targets to take commission, there could be chances of manipulation in franchise. To assist with the expansion, a networked computer system has been installed during the year on the advice of the friend of 2 directors. So companies are having a newly installed IT system. So due to early stage control weaknesses, chances of error in financial statements, we can write in inherent risk. or due to early stage control weaknesses, chances that misstatement may not be prevented, detected, corrected by the system, we can write under control risk. So you can either write in inherent or control, not in both. Okay. One issue can be written as inherent or control. The previous auditor resigned after a loss of confidence in them by the board. This arose as a result of disapproval of the board of a qualified opinion in the audit report concerning inadequate control over system, inappropriate accounting policies, and a bitter. It's not a biker, it's a bitter, BITTITER. Bitter dispute over fee level. So previous auditor resigned due to some issues. Those issues could also affect us in the future. And due to those reasons, auditor may not be able to detect misstatements. Detection is a fine. Let's move towards another question or take a break. Let's take a break, small break, and then we will discuss some questions from the kit. Exam level questions, past paper questions, the level questions.
Yeah. Yeah, sure.
Okay, let's discuss some questions on audit risk from Kit. Question 73. There are different requirements. Requirement A for 4 marks. Requirement B for 5 marks. And requirement C for 16 marks. Requirement D, we are unable to cover now. Even requirement C, half part to identify audit risk, we can cover now. Audit response, this is relating to procedures that we will cover in future. But now we will identify 8 audit risk from this question. So describe 8 audit risk and explain the auditor's response. Obviously, auditor response part we will not covering. We are just covering to identify 8 audit risk from the scenario. Let's discuss. It is 1st July 20x5. Assume that it is 1st July 20x5. You are an audit supervisor of Orange and Company. I mean, this is the name of audit firm. Planning the audit of a new client, Scarlet Company. I mean, your client company name is Scarlet Company and it is a new client. Is there an issue with the new client? Yes. Auditor is new. Auditor is new. So due to lack of detailed knowledge about client business, he may not detect the misstatement. So this is detection risk. For the year ended 31st May 20x5, year ended is 31st May 20x5. Always Scarlet Company manufactures chemicals, domestic and commercial cleaning product. They manufacture cleaning chemicals, cleaning material. The company's financial accountant was taken ill suddenly in May 20x5. In last month of the year end, the financial accountant became ill and is unable to undertake the preparation of the year end draft financial statements. As a result, the company recruited a temporary financial accountant in early June 20x5 who will prepare draft statements. The main accountant is ill. Company has arranged temporary staff and temporary staff might not be having day knowledge about accountancy issues. So there could be chances of errors in the new staff. The year-end financial statements need to be finalized quickly. It's not it. Year-end financial statements need to be finalized quickly. The company is looking to raise finance through a bank to delay 3 months machines in the productivity. So I'm going to obtain bank, and if condition of the bank loan approval is not fulfilled by the company, there are chances of manipulation in financial statements. Inherent. Bank asked for a company. Bank asked for a copy of the audited year-end financial statements by the end of September 20x5 before they will agree to the loan, and the directors are keen to report strong results in order to obtain this financing. This means there are some conditions. In the year, the company also purchased a specialized machine to develop a new range of chemicals for a major customer. Only trained staff are allowed to operate this machine, and the staff member had to undertake 2 days of training, followed by an assessment at the end of the training period. The training cost of 15,000 had been capitalized as part of cost of the asset. Company have capitalized 15,000 training cost to the asset cost. For IA 16, training cost should be treated as expense rather than capitalized. It should be treated as than capital expenditure. Training cost to asset instead of charging expense, chances that asset profit could be overstated and expenses understated. Training cost should be expense out rather than capitalized to the asset cost. And if company capitalizing training cost, chances that we will not say there are overstatement. No, chances that we are at the planning stage. So chances could be, we will use word could be chances. So chances that asset profit could be overstated and expenses. At planning stage, we cannot say this is misstated. We can say could be misstated. Because during audit, we will verify these things. We will perform procedures, we will obtain evidence, and based on evidence, we can say this is misstated or not. Without evidence, what we will say could be chances. Please be careful about the wording. We are highlighting these areas at planning stage. The company sources many of its raw material to be used in the chemical manufacturing process. If the question is having so many small paragraph, this means in every paragraph there is at least one risk. Some paragraph having more than one, but at least one risk is always there in every paragraph. So the company sources many of its raw material to be used in the chemical manufacturing process from an international supplier. Can be transit for up to 3 weeks. So company is purchasing raw material from international supplier and it take 3 weeks to deliver goods in the company. So there could be issues. Might be in the last week of a year and reported purchase, but the goods is not delivered until last day of the year. In company recorded inventory, but the inventory is not record inventory arrive into your business. In your business, and if you have recorded on order, especially order relating to last week of current year, so due to this, inventory could be overstated in the statement. The agreement with the international supplier contains a clause which states that a certificate company is responsible for the goods as soon as they leave the supplier warehouse. So you have to record inventory when it transported from supplier warehouse. Company is responsible for that inventory, not the supplier. So might be companies having policy, we will record inventory when inventory will arrive at our hedges, because inventory should be physically there. So there could be chances of over as well as understatement of inventory. There could be chances of over as well as understatement of inventory because company policy to record inventory is not stated there. Might be their policy, we will record inventory when it will arrive in our warehouse. But according to supplier, when it has been transported, started transportation from my warehouse, I have no Obligation with inventory, it's your. Okay. This means company have to record. So it's according to policy of the company, inventory could be over or understated. You have carried out a preliminary analytical review, mean performed analytical procedure at planning stage. Analytical review mean perform, analytical procedure mean comparison of different data, which indicates that the receivables collection has increased from 38 days to 52 days. Mean receivable days has increased. Mean company were receiving from customer in 38 days. Now they are receiving in 52 days. Mean is struggling to recover from the receivables. If it is struggling, there are chances of bad debts. And if provision for doubtful debts, or you can say irrecoverable debt is not recorded properly, chances that asset profit could be overstated, expenses understatement. What is the entry of recording bad debts? Irrecoverable debt, expense debit, receivable credit. If you haven't recorded this inventory, this means expenses understated, profit overstated, and if you haven't reduced the receivable, asset could be overstated. Is it fine? And the credit controller has confirmed that some customers are currently taking longer to pay than in previous year as they are awaiting payments from their customers. And if they will not receive from their customers, they will not pay us. So there are chances of bad debts for which we need to record provision for doubtful debts, mean irrecoverable debt. Inherent risk. So on 29th of May, what was the year end? 31st May, 2 days before year end. On 29th of May 20X5, the director announced that one of its brand was being discontinued due to a fall in demand for the product. And they are going to discontinue one of their brand. This resulted in 4 staff members being made redundant. There should be redundancy provision. For IAS 37, if company is not recording redundancy provision, chances that expenses, liabilities could be understated. What is the entry of a provision? Expense debit, provision liability credit. If both are not recorded, expenses understated, liabilities understated, and if expenses understated, what could be the profit? Overstated. Is that fine? The payroll department has calculated the levels of termination cost associated with the redundancy, and they will be able paid in July 20X5 payroll run. This means it's meeting condition of provision, constructive obligation, probability, and they have calculated the cost as well. So for IAS 37, there should be provision. Is that fine? Any confusion? While attempting this question, first you need to read answer from the kit, then attempt this question with your hand. Because by reading an answer, you will get an idea how to make sentence, how to sum up this issue in 2 to 3 lines, how we can link with the misstatement. So here the check will be paid. Do we still have present legal constructive obligation from past event? Mean we have to pay in future, probability of future economic outflow. Yeah, yeah, this is a provision. If they don't record this, what we are saying, if redundancy provision is not recorded in the financial statement. Okay. Chances that, there should be provision entry in the financial statements. Now, the directors each received a significant bonus in last year, which has been included in the payroll charge for the year in the statement of profit or loss. Local legislation requires separate disclosure of director bonus in the financial statements. So director remuneration is based on bonus, will be paid on meeting certain targets If required targets is not fulfilled, chances that financial statement could be manipulated. And legislation required disclosure in the financial statements. And if director bonus are not disclosed properly in the financial statement could be misstated. So we can try both point, manipulation as well as non-disclosure. But risk will be one, not two. During the year, the company sold a batch of chemical to a customer for 120,000. At the beginning of May 20X5, the company returned these chemicals because the chemicals mix was not in line with the customer specification. There is sale return. A credit note, again sale return, company issue credit note. Credit note is yet to be issued to the customer and the chemicals have been written down to their scrap value within inventory. So when we made the sale in current year, the credit note is yet to be issued. This means credit note at year end was not issued. So might be sale return was not adjusted in the year to 31st May 20X5. If sale return was not adjusted to year end 31st May, so chances that sale could be overstated. Not only sale, even inventory could be understated because this inventory is coming back to the business. So should be adjusted in 20X5 financial statements rather than next financial statements. This is due to year end issue. Because currently, what's the date is current? What's the date is current? He said current date is 1st July. And this sale return is relating to sale of May. Still, there is no credit note issued. The sale return is not recorded. So this should be adjusted in 31st May financial statement rather than next financial statement because the sale return is related to previous financial statements for which we are going to audit. And if inventory is coming back because it's faulty, so might be company have recorded this inventory on cost basis, but it should be recorded on NRV basis. Because if it is defective, their NRV will be either nil or very low. So there could be chances of overvaluation of inventory if they adjust it to the current financial statement. The companies usually pay its supplier by the end of each month. However, due to the financial accountant's illness, the payment run for May 20X5 was not performed until 1st June 20X5. The finance director has informed you that in order to show consistent result with the prior year, this payment run is shown as an unpresented item on the year-end bank reconciliation. Mean the payments of supplier relating to May month is not yet paid end of month. Normally company pay. So might be company have omitted the liability and recorded it as a unpresented item in the bank reconciliation. If they have omitted the liability is still there because you haven't paid till year end. So chances that liabilities could be understated. Because if you have recorded as unpresented, this means you have made the entry payable debit, bank credit. While payment was not made till year end. The liability should be there in the financial statements at year end. So chances that liabilities could be understood. 8 risk. Have we identified 8 risk? 1 in first paragraph, 2 in second paragraph, third, fourth, fifth, sixth. In every paragraph, we have find one. What is the requirement A? ISA 210 agreeing the term of audit engagement require auditor to issue an engagement letter. Engagement letter. We have discussed in previous class. Explain the purpose of engagement letter. What is the purpose of engagement letter? Is to avoid future misunderstanding and agree term of engagement with client. This is a formal appointment letter of the audit. And list 4 items which should be included in audit engagement letter. What are the elements? Nature and scope of audit, management responsibility, auditor responsibility, basis of fee, applicable financial reporting framework. We can list down so many. Requirement B for 5 marks. And these easy marks normally students miss while attempting question because they ignore these easy marks. But these are 100% marks that you can keep. If you are having knowledge, you can attempt fully. So explain why the following factors should have been considered by Orange and Company prior to accepting Scarlett Companies as a new audit client. I mean, why before accepting the audit, we should look for these factors. The outgoing auditor response, mean professional clearance. Why we should obtain professional clearance? We need to write down the purpose. Why we should obtain professional clearance? Why we should obtain professional clearance? In why we should ask the previous auditor why you are not continuing. Why? Because if there is any issue with the previous auditor that is restricting his scope of work, it could arise, it could affect our work in the future. And if there are serious concerns, we should not accept the audit. I mean, just explain purpose in English. Examiner asking to write down English. Why we need to see management integrity before accepting the audit? Because if management integrity is lacking, there could be chances of fraud, errors, mean more misstatement in the financial statement. This means we need to conduct audit with more experienced team. If integrity is doubtful, this means audit risk is high. We should adopt substantive approach rather than system-based approach. Why we should check these things before accepting audit? Preconditions for an audit. Why we should consider preconditions? To agree management responsibility with them regarding preparation of financial statements, implementation of internal control system, providing information relating to audit to the auditor, and providing unrestricted access to company records for audit purpose. In examiner required, you need to write down what are the preconditions. Independence and objectivity, why we need to ensure before accepting audit? To check if there is any threat on independence, we should take steps to reduce or eliminate it. I mean, what steps we can take regarding mitigation of the threat. Why we need to check whether we are having the resources and a time for the audit. We need to make sure whether our staff is having skill, experience to conduct the audit, because if we are lacking resources, our audit quality could be compromised, which leads towards inappropriate opinion, i.e. audit risk. Why we should check these things before accepting the audit? Just write down English. Just write down English. So practice this part as well now after the class, so that if examiner asks similar question again, we can write something. So let's move towards one more question. Question 72. What we need to do for question 72? Requirement A. Describe the auditor's responsibility in relation to prevention and detection of fraud and errors. We haven't covered this topic. We will cover this topic in next lecture. This is available in chapter 6. Currently, we are covering chapter 6. It's a big chapter. Part B, calculate 4 ratios listed in the table below for both years. Assist you in planning the audit of Harlan Company. You need to calculate gross profit margin for both years. And you are having data for 20x5 and 20x4. How to calculate gross profit margin? GP over sale into 100.
Yeah.
So you can calculate GP margin for both years. Can you calculate this? Come on. Come on. Quick, quick, quick. GP over sale into 100.
19.39.
19.39 by 20x4, 5. 5. 20x5, 19.39. Anybody with different answer? Oh, same. And what about 20x4?
19.39.
19.39 is fine. What about 20x4? 10.95. Anybody with different answer? Saying 13% or 2%. So 10 point something percent. Is that fine? Okay, can you calculate inventory holding period?
Inventory holding period.
How to calculate inventory holding period? Inventory over cost of sale into 365. This is the figure for inventory. This is figure for cost of sale into 365. We will calculate inventory days. Inventory holding period mean inventory days.
So for 2014.
Yeah, it's 21.
Yes. Also, okay.
GP margin for 20x4 is 21%. For 20x5, it was 19 point something percent. Please calculate inventory days for both years.
Inventory.
Days. Inventory over cost of sale into 365. How many days in a year? 365. I'm assuming you people have studied financial accounting. There was a chapter in financial accounting, interpretation of financial statements ratios. 14.9 days for 20x4.
40.
40.9 mean 41 days. What about 20x5? 33. This means they have been reduced as compared to 20x4. Reduced
No.
Increase.
41 to 33.
33.
33 in 20x4.
I think the 40.9.
40.9 in 20x5.
Yeah,
Okay, increased.
increase.
What could be the reason? Might be there is some obsolete inventory.
Or they're not yet.
That company is not recording its losses. So inventory could be overvalued. Okay, what else we need to calculate? We need to calculate gearing. Gearing, how to calculate gearing? Debt over debt plus equity. This is debt and this is equity. Debt over debt plus equity mean 13,000 divided by 23,000 into 100. Debt over debt plus equity. 56.5% for 20x5. What was in 20x4? 56.5 for 20x5. What was for 20x4? 53. This means this has increased. The more gearing mean company is more risky. Good. Going towards cash flow going some issues. And you need to calculate interest cover ratio. How to calculate interest cover? PBIT, profit before interest and tax. You are having profit before tax, not before interest and tax. How you can calculate profit before interest and tax? 450 add 290, you will be having a profit before interest and tax. Divided by interest. So 450 plus 290. 740 will be profit before interest and tax. Divided by interest 290. What is the answer? 2.5. 5. What's the interest cover for last year? 850 plus 250, this will be 1100 over 250. 4.4. Last year it was 4.4. Current year 2.5. This means company is struggling. Last year, company was able to pay 4 interest installment. Now company is just able to pay 2 interest installment. This means company is struggling, could move towards going concern issues which may not be disclosed properly. But the requirement was just to calculate these ratios. So requirement A, requirement B done. There are 4 marks for calculating these ratios only. It's not relating to audit. To calculate these ratios is not audit.
Yeah.
It's just accounting. And examiners are gifting you 4 free marks in audit purpose.
Yes.
This means always take calculator while going to audit paper. Take calculator in every paper of ACCA. Even in BT, even is a law, you should have calculator with you. Don't consider you don't need calculator in this theory paper. No. Requirement C. Using the information provided and the ratios calculated, describe 8 audit risks. From the ratio, can we calculate, identify risk? Gearing has increased, interest cover has fallen. This means company is struggling in cash flow. Company could face going concern issues which may not be disclosed properly in the financial statement. Inventory days has increased. So there are chances of obsolete inventory. If company do not record obsolete inventory per a standard lower of cost NRV, inventory could be overvalued. Remaining risk we can identify through scenario information. Mean from ratios examiner could ask to identify risk. GP margin increased or decreased as compared to previous year? Increased. So chances that either sale could be overstated or cost of sale understated. Could be.
That the trade receivable has increased from 38 to 51 days.
Yeah, receivable days, where are receivable days?
No.
Okay, let's read from the top. It is the 1st July 20x5. You are an audit supervisor of Brooklyn and Company and are planning the audit of Harlem Company for the year ended 30th September 20x5. Where it said it's a new client? No, it didn't say it's a new client. Might be you are performing audit from so many years. You're planning the audit. The company has been a client of your firm for several years. They have cleared. And manufacturing car tires, selling its product to wholesalers and retailers. The audit manager attended a planning meeting with the finance director and has provided you with the following notes of the meeting and financial statements extracts. Planning meeting notes. Harlem Company sells approximately 40% of its tire to wholesale customers. These customers purchase goods on a sale or return basis. Under the term of the agreement, wholesale customers have 60 days during which any return can be made without penalty. The finance director has historically assumed a return rate of 10%. This means if you are making sale on sale or return basis, and historically your history 10% sale come back to the company. This means for this 10%, you should not record the sales revenue because there are chances that will be returning back. So you should record the sale to wholesale customer with 90% rather than complete 100%. Or if you are recording 100% sale, then you need to create premium for that 10% return. Because you might be paying back to the customer against sale return. So if company is recording 100% sales without premium, if company is recording 100% sales without premium, so chances revenue profit could be overstated. Common sense. However, he now feels that this is excessive and intends to change this to 5% and he want to reduce the sale return to 5%. How he can reduce to 5%? How he can reduce to 5%? How?
Make this real.
By improving quality or something like that? Might be he has set a target of reduction in 5%, and if that 5% reduction target is not met, what he will do? He will manipulate the result. So there will be chances of manipulation in sales revenue. Because you cannot reduce this. If history is 10%, you cannot reduce this to 5%. Because to reduce this 5%, you need to improve your quality. If there is nothing done to improve quality, so this target will not be met. And if not meeting the target, chances that sales figures could be manipulated. So we can identify one risk from here. The company purchased a patent on 30th September 20x4 for 800,000. Patent means intangible asset. For tangible asset, company need to depreciate. Intangible asset need to amortize over its useful life. In the same way, we depreciate the tangible asset, cost over useful life. In the same manner, intangible asset, depreciate it. The word depreciation is changed with amortization. How to calculate cost over useful life. So company have purchased patent mean intangible asset on 30th September 20x4. What's the year end? 30th September 20x5. For 800,000, which was capitalized in the prior year as an intangible asset. That's fine. They can record as intangible asset. This patent gives Harlem Company the exclusive right to manufacture specialized wet weather tile for 4 years, and this patent is for 4 years. This means this patent asset should be amortized over 4-year period. And if company is not amortizing the asset, chances that expenses could be understated. Profit asset could be overstated. Is that fine? If company not amortizing intangible asset over 4-year life, me not recording depreciation, what could be the issue? Asset will be overstated. There is no expense, expenses could be understated. And if there is no expense, profit could be overstated. In preparation for the manufacture of the wet weather tire, this year the company conducted a review of its plant and machinery. As part of this review, surplus item of plant and machinery were sold, resulting in a loss on disposal of 160. The company have sold some of the plant machinery and made a loss of 160. This loss should be recorded where? Profit and loss account. Loss on disposal. And if company not recording this loss in profit and loss account, profit could be overstated. And the disposed plant should be removed from the plant asset. If not removed properly, asset could be overstated. Why there is a loss on disposal? This means the market value of asset was lower than the carrying value. Why carrying value was higher than market value? This might be company was not depreciating the asset appropriately. Mean they were under depreciating the asset. And if they were under depreciating the asset, there are chances that asset profit could be overstated and depreciation expense overstated. But we can simply say if the loss is not recorded in profit and loss account and asset is not eliminated from the plant and machinery, asset profit could be overstated. Chances because normally management what they want to highlight profit, to highlight assets. Okay. So in May 20x5, the financial controller of a Harlem company was dismissed after it was alleged that she had carried out a number of fraudulent transactions against the company. If there was fraudulent transaction, those should be corrected and disclosed in the financial statement. And if the fraudulent transactions were not corrected or disclosed, financial statements could be misstated. Fraud. She has threatened to sue the company for unfair dismissal as she disputes the allegation. The company has only recently started to investigate the extent of the fraud in order to quantify the required adjustment. Mean the fraud adjustment not done. And she is going to sue for unfair dismissal. So there should be chances of provision or contingent liability as per IAS 37. Because not clear whether she will won the case or company will won the case, because if company has proved the dismissal was fair, then there will be no premium. But if she proved the dismissal was unfair, then there will be provision. So there could be chances of provision or contingent liability. If not accounted properly, financial statement could be manipulated or misstated. So we write two separate things. One for unfair dismissal and one for fraudulent transactions. Seems easy now, but while writing, it will become difficult. So you have to attempt this question, practice this question either today or maximum till tomorrow. If you will wait, next class is on next week, so we can attempt either in 4 or 5 days. No,
We will forget.
you will forget the knowledge. You will not be able to answer quality. This is technical. So you have to practice this area either today or maximum by tomorrow. So a problem occurred in June 20x5 during production of a significant batch of tires which affected their quality. The issue was identified prior to any good being dispatched, and management is investigating whether the issue can be rectified and the tire can subsequently be sold. So there is issue of a faulty goods. In faulty inventory. If inventory is a faulty, this means their NRV will be lower than its cost. Then if company not recording the faulty inventory lower of cost, NRV, inventory could be overvalued. Inventory could be overvalued. We are learning how to identify risk from this issue. Harlem Company's finance director has informed you that in March 20x5, a significant customer was granted a payment break in 6 months. We have asked the customer, okay, you can pay us after 6 months. 6 months. After 6 months, will you be sitting in this class? No. Where you will be, nobody knows. So you are asking your customer, you can pay me after 6 months. Will he pay? No. As it has been experiencing financial difficulties, he is facing financial difficulties. And there is no guarantee he can recover his difficulties in 6 months. Harlem Company maintains an allowance for trade receivable, and it is anticipated that this will remain at the same level as prior year. No, there will be more allowance for receivable as compared to previous year.
Yes.
Because you are allowing customer 6 months more. And if company is not increasing allowances for irrecoverable debt, chances that asset profit could be overstated and expenses understated. Is that fine? So allowance, irrecoverable debt. The report to management issued by Brooklyn and Company following last year audit highlighted significant deficiencies relating to Harlan Company's purchase cycle. Previous year auditor highlighted some deficiencies in a purchase cycle, mean internal control weaknesses. If management haven't corrected those internal control weaknesses, chances that misstatement may not be prevented, detected, corrected by the system control risk. The finance director has informed you that the company intends to restructure its debt finance. Might be they want to renegotiate with the bank, might be the loan is due, but they are not able to pay. That's why they are going to restructure, renegotiate after the year end, and will be looking to consolidate its loan to reduce the overall cost of borrowing. Might be they are struggling to pay the interest rate. That's why they are going to renegotiate with the bank. If they are struggling, there are chances of cash flow going some issues. Or if a bank don't restructure, don't renegotiate, it will create cash flow going some issues for the company, which may not be disclosed properly in the financial statement. As a result of the planned restructuring of debt, Harlan Company has not paid its shareholders a dividend this year. Not paying dividend is also a sign of cash flow issues. Choosing instead of undertake a bonus issue of zero point 0.5 equity shares. Instead, you are issuing bonus. In case of bonus issue, you have to reflect this in share capital as well as in reserve. And if company haven't recorded the bonus issue to increase share capital or reducing the reserve, chances of manipulation in the financial statement. You have been asked by the audit manager to complete the preliminary analytical review that has provided you with the following information that we have performed ratios. There is one more point. The audit assistant has already calculated some key ratios for Harlan Company, which you have confirmed as accurate. She has ascertained that the trade receivable collection period has increased from 38 to 51 days. In debtor days has also been increased. We will link this ratio here in this point. Like as company has provided more credit period to the customer and customers are struggling to pay, and debtor days has increased as compared to previous year from this to this. So there are chances of more bad debts. And if company recording provision for doubtful debts as per previous year, not more in current year, so chances that asset profit could be overstated, expenses understated. We will link that ratio in this point. And then we will be able to answer quality. 8 audit risk. We are having more time. We can cover one more question. Yes. Question 71, please. What we need to do? Define and explain materiality and performance materiality. Can you define materiality and performance materiality? Misstatements are material if they influence economic decision of user, could be judged either quantitatively, qualitatively. Performance materiality, setting materiality level below materiality as a whole financial statement. Part B. You need to identify 8 risk and response. We are not able to right now. So identify 8 risk. It is 1st July 20x5. You are the audit supervisor of a Daffodil and Company, and you are planning the audit of a Peony Company for the year ending 31st May 20x5. The company is a food retailer. Food retailer. Nature of company says company is food retailer, and food items become perishable, obsolete quickly.
Yes.
So there is chance of overvaluation of inventory if obsolete inventory, perishable inventory is not recorded, door of cost and NRV. Is that fine? With a large network of stores across country and 4 warehouses, we can identify one detection risk from here. There are so many stores across country.
Control.
And due to lack of audit staff, if we are unable to perform audit on all stores, so auditor may not detect misstatements. Detection risk.
Not control.
Even you can say control because companies' operations are expanded. So there could be lack of controls which may not detect correct misstatements. It's better if you write to detection risk.
Okay.
Either detection, either control, not both.
Okay.
The company has been a client of your firm for several years and the forecast profit before tax is 28.9 million. The audit manager has attended a planning meeting with the finance director and has provided you with the following notes of the meeting. Pony Company has an internal audit department which undertakes controls testing across the network of stores. Each store is visited at least once every 18 months. After 1.5 years, he is visiting. So if he is not visiting the stores on regular basis, so due to lack of monitoring of control, misstatements may not be prevented, detected, corrected by the system. Despite having internal audit department, there is lack of monitoring. Control risk. The audit manager has discussed with the finance director that the external audit team may rely on the control testing which is undertaken by internal auditor. During the meeting, the finance director provided some forecast financial information. Revenue for the year is expected to increase by 3% compared to 20x4. Gross margin is expected to increase by 56 to 60%, and operating margin is predicted to decrease from 21 to 18%. I mean, he is going to predict sale should increase by 3%. GP margin by 4%, while operating margin should reduce by 3%. So these forecast is not in line with each other. Mean operating profit will reduce while GP margin will increase.
Yes.
So there could be chances of misclassification of direct expenses to operating expenses. Mean if he misclassify direct expenses mean relating to cost of sale to operating expenses, then he can meet this target. Mean GP margin will increase while recording expenses to operating expenses, operating margin will reduce. Otherwise, if sale is increasing, GP margin increasing, profit margin should also increase. So his target forecast is not in line with each other. So there could be chances of, if target forecast is not met, there could be chances he can misclassify direct expenses to operating expenses. Otherwise, they all should be increasing. If any company values inventory in line with industry practice, which is to use the selling price less average profit margin, how we should record inventory? Lower of cost and NRV. What is NRV? Selling price less cost to sell rather than less average profit margin. So inventory could be either under or overvalued. If not recorded as per IAS 2, lower of cost and NRV, i.e. selling price less cost to sell. But he is calculating NRV, selling price less average profit margin. No, not profit margin, cost to sell. So due to this, inventory could be either under or overvalued.
So to memorize all this,
IAS 2 is better
like the top.
if you mention the standard number. Otherwise, as per standard, inventory should be recorded lower of cost and NRV.
Only I.
There are so many. But don't worry, don't need to state the standard number. Standard knowledge, you have to state. While attempting question, you will learn automatically IAS 16, IAS 2 inventory is coming in almost every question. So we can make reference. If there is chance of provision, we can make reference of IAS 37 just to impress the examiner.
Yes,
Because according to examiner, to be an auditor, you must be an accountant. Without accounting knowledge, you cannot highlight
yes.
issues. So to impress him, we are aware of accounting standards. Okay. So we have identified from here. The director considered this to be a close approximation to cost. No, this is wrong. So should be lower of cost and not. The company does not undertake a full year inventory count and instead undertake monthly perpetual inventory count. Perpetual mean continuous. Every month they are counting inventory. While preparing financial statements, company have to count the inventory at year end and then value them and state in the financial statement. But they are not undertaking a full year end inventory count. This means inventory balances could be over or undervalued. There should be year end inventory count. Each of which covers 1/12 of all items in store and the warehouse. As part of this interim audit, which was completed in January, the audit junior attended a perpetual inventory count at one of the warehouse and noted that there were a large number of exceptions, mean issues, mean inventory record showing something different while physical inventory is different. Exception mean mismatch issues, where the inventory record show a higher quantity than physical inventory which was present in the warehouse. So when discussing these exceptions with the financial controller, the audit junior was informed that this had been a recurring issue. Mean it happened normally. But if this is the issue and you are not recording inventory on year end account, so inventory could be either under or overvalued.
This covers 1/12 of all lines.
Mean checking inventory on sample basis instead of 100% testing. So during a year, internal auditor performed a review of the non-current assets physically present in around 1/3 of the company's store.
Yeah.
He didn't check non-current assets physical present about 2/3. There might be chances asset recorded in the record but not physically present. So a number of assets which had been fully depreciated were identified as obsolete by the reviewer. In the assets, some assets are there fully depreciated, but they are obsolete, mean not working properly. So there are chances asset could be overstated if depreciation is not properly recorded or if they are not present physically. The company launched a significant TV advertising campaign. Advertising expenditure where it should be recorded. Profit and loss account, admin expenses, selling or distribution expenses. In January 20x5, in order to increase revenue, the directors have indicated at the year end a current asset of 0.7 million will be recognized. No, this is not asset, this is expense. If company is recording as asset rather than expense, asset profit could be expenses understated. As they believe that the advertise will help to boost future sales in the next 12 months, the last advertisement will be shown on TV in early May 20x5. Whatever obviously is advertisement will boost sale, but it is revenue nature expenditure rather than capital nature. So Peony company decided to outsource its payroll function to an external service organization. Mean company payroll who will prepare any external accountancy firm. So service organization mean any external accountancy firm will prepare their payroll. This service organization handles all elements of payroll cycle and sends monthly reports to Peony company which details wages and salaries and statutory obligations. Peony company maintained its own payroll record until 31st December 20x4. Mean till 31st December 20x4, they were preparing payroll within the company. From January onward, what's the year end? 31st May, they have outsourced. So half month they were preparing by themselves, remaining half month they were preparing from outsiders. And if there is a mismatch in calculation of in-house and outsider payroll, expenditure could be misstated.
So which is that? Which
Inherent risk misstated. Even we can say detection risk, because for half month record are available in the company, we can verify. For remaining half months, where are the record?
Yeah.
Outside the company. We cannot verify in any other accountancy firm. They will not allow us to enter in our premises because might be they are our competitor firm. So there will be detection risk. Auditor will not be able to detect half months payroll expenditure. So at which point the records were transferred to the service regulation. Peony company is planning to expand the company by opening 3 new stores during the July 20x5. And in order to finance this, so company is going to open 3 new stores, control risk. And to finance this, in March, the company obtained a 3 million bank loan. So there are chances of manipulation to meet the condition of bank loan approval. This is repayable in arrears over 5 years in quarterly installment. If there are quarterly installment, this means you have to classify current liability and long-term liability. So if there is no proper classification, financial statement could be manipulated. In preparation for the expansion, the company is looking to streamline operation in the warehouse and is planning to make approximately 60 employees redundant. No decision has been made as when this will be announced, but it is likely to be in May 20x5. So there should be redundancy provision for IAS 37. If there is no provision recorded, expenses liabilities could be understated and profit overstated. I need answer of these 3 questions before next class. Or I can give you 2 questions for your homework as well. Mean I need answer of 5 questions before next class. Before next class.
Okay.
Before next class. 71, 72, 73 we have covered in the class. And 74 part A and B you have to cover by yourself. 71, 2, 3, 4. Even you can cover 75 as well, yes. 75 part B1 and 2 as well. 71, 2, 3, 4, 5. These 5 questions you have to attempt before coming to next class, please. If you want to pass this paper in this attempt. If you don't want to pass this paper in this attempt, then you can attempt later on after this semester, after this attempt. It's up to you. Choice is yours. Please keep in your mind to pass this paper in this attempt. You have to spend 200 hours while studying this paper. You have to spend 200 hours. 50 hours we will cover in the classes.
The rest,
Remaining 150 hours you have to spend at home. If you want to pass this paper in this semester, please keep in your mind. Practice, practice, practice.
okay.
Written practice. Not, oh, we have covered this question. Oh, these are the results. That's fine. We can find in paper. That's fine. No issue. While sitting in the paper, you will be in trouble.
Like study hub,
Study hub.
and
What does that mean?
ACCA study hub.
It's just online portal where they have notes and questions.
Yeah.
Just these are everything is shared on a team. I've shared these things in your group as well, WhatsApp group as well. Yes. So you can take from there. Do you need any hard copy? No need for hard copy.
No,
No need for hard copy.
yeah.
So try to write down answer. It's better if you write down answer in computer, Microsoft Word, typing,
Okay.
because your paper will be computer based rather than paper based. Is there any option of paper based exam? No, there is no option now. You have to attempt on computer, so try to write down answer in computer.
My hand is slow.
So question 71, 72, 73, 74, 75. These are 5 questions you have to cover before coming to next class.
Tuesday.
In next class, we will discuss something. See.
Thank you, sir. So can I talk to you for 5 minutes?